All right. Hello, everyone. Good afternoon. And thank you, Jamie, for the introduction. It's a privilege for Sightline to be the knowledge partner of the Energy Tech Summit this year and to present the keynote of financing the climate capital stack. I believe this is the last keynote, so thank you for joining me today. I hope you all had a great conference so far. Sightline is an intelligence provider tracking investment flows, projects, and signals to understand where capital is flowing, what is being built, and what's coming next in the climate and energy tech space. Today, I'll be sharing a preview of the key findings of our 2026 Dry Powder and New Funds report, which will come out next week. Our clients in the room will have access to the analysis on the platform, and our CTVC newsletter subscribers will have access to the insights in an upcoming edition as well. So, the climate and energy space finds itself in a unique moment in 2026, and I wanted to start this presentation with some good news. There's plenty of dry powder for climate tech. We've calculated that as of Q1 of this year, there's $90 billion available for deployment across the capital stack. 2025 was, in fact, a record year with peaks of over $100 billion available for deployment. And the deployment of that capital is also rising. Last year, funding across verticals rose by 10%, led by funding for energy, which cemented its top position after taking over transportation in 2024. The deployment, however, has not kept up with deal counts, as they fell to a 4-year low. This means that we're seeing a rise in much larger deals. This is a unique moment for climate tech investment and for the transition. And in this moment, I want to give you 3 themes to think about for the year to come. The first is about the rise of Europe. In the uncertain geopolitical environment that we find ourselves in, the world is looking to Europe for climate leadership, and that is coming through in where the capital is forming and where investment is flowing. The second theme is that it's time to go back to basics. Investors are focusing on returns and on scaling the infrastructure that we already know will work and will reduce costs, increase energy security, and resilience. The third theme is the path forward for innovation. We are still going to need new technologies, first-of-a-kind projects, and startups in order to grow our economies and respond to the climate challenge and the growing impacts. So let's start by talking about Europe. Last year, Europe beat all other regions on the number of climate tech investments. It is truly the center of climate innovation across all verticals, with continuous funding in energy, transportation, industry, food and land use, carbon, and climate management. Its funds are a leading indicator for the shift that we've been hearing away from the US. In terms of both value and fund count, Europe is leading. Comprises over half of new funds by value and over 40% of new funds by count. Climate investors in Europe are moving forward and are ambitious about the scale and the pace of the transition. Canadian and European investors are leading that shift and leading fundraising, but also closing. And these are not first-time climate investors either, but repeat players like Brookfield, Energy Capital Partners, CIP, that have raised their 3rd, 4th, 5th fund to invest in energy and climate tech. They have demonstrated their returns, and their institutional investors are coming back with more capital to back their deployment. This translates to more stable capital formation in Europe than in the US. Last year, European funds closed at an average 71% of their target fundraising. By contrast, US close rate stood at a mere 35%, down from about 80% 5 years prior. Overall, this close rate has been down from over 90% in the 2021-20 post-COVID recovery boom, but European fundraising has been much less volatile than the US. Now, this is in large part thanks to the policy backing that is needed for innovators to know that they can deploy their technologies and be competitive. Europe's carbon border adjustment mechanism, the EU and UK ETS, are going to have a dramatic impact on the price of imports like aluminium, cement, ammonia, steel into Europe. That will drive low carbon technology projects everywhere and make European industrials more competitive as soon as this year, as the system phases in. Suppliers are lining up to feed Europe's demand. We're seeing a rise in projects with European offtakes that are going forward, for example, in low carbon ammonia or in sustainable aviation fuels. The reason is that the price signal that CBAM creates for decarbonization makes these projects bankable and possible. Now, a lot of investors are keen to go back to basics. The important thing to remember here is that the original driving force for nuclear, solar, and wind wasn't emissions reduction. It was about the idea that countries could produce their energy domestically and make their supply chains and systems more resilient. In times of crises, these are the themes that we're seeing come up again and again in our mega deals. So you can see here on this chart the biggest deals of 2025 by sector. And if we break these down by the two themes of energy security and system resilience, this is what you'll find. You'll see that nuclear power is the ultimate energy security play. That top deal is China investing 1.6 billion in a spin-out called China Fusion Energy. The country is attempting to establish its dominance in technology and compete with Americans like Commonwealth Fusion Systems. X-Energy and TerraPower are deploying SMRs, promising clean, firm, scalable power for data centers, a way to rapidly deploy the next generation of nuclear power plants. Now, on system resilience, it's a tale of two stories, really. BASE is making consumers more resilient to power interruptions by installing storage and operating it as a virtual power plant. EelPower is a UK startup that is reinforcing the grid centrally by deploying storage. Both of these solutions mean that more physical infrastructure is going to be built. And luckily, that funding is coming in for it. Infrastructure funds last year made 77% of new climate assets under management. We saw that these funds were mostly anchored in the EU and Canada, and that money is now ready to flow towards clean technologies that provide that security and resilience. There are several star players that we've been monitoring in the pipeline that could benefit from this drive in 2026. Top of mind are Octopus Energy, Base Power, Fervo. That's some of the names that are ready to move to the next stage, either privately through these funds or publicly through IPO. Now, to my last theme of the day, innovation. Going forward, innovation is going to focus less on direct emissions reduction, but rather on what the system needs now in order to transition to lower carbon power. As a startup, meeting the moment will mean bringing costs down and increasing energy security. In our latest analysis, we're seeing the top of the funnel drying up as of mid last year. This means that VC funds are not raising capital as fast as they are deploying it. The number of VC and growth funds being raised for climate tech has held relatively steady at about 100, but have not closed that target, especially in the US, where the policy risk has become too important. This is especially stark when you compare it to the infrastructure funding that has been raised. The most active LPs in the space are also focused on those large infrastructure projects. They're major development finance institutions, investment banks, corporates that are thinking about how to compete on power in the age of AI and are ready to invest large tickets for that technology. It was nonetheless a record year for a lot of venture capital investment for sectors that are feeding into those ideas of growth and system resilience and returns and lower costs. Wildfire Tech, for example, was up 69% to help utilities prevent the catastrophic damages and costs that we've seen rise in the past 5 years. The grid is the center of the power system, and the technologies that are allowing it to move more power have gathered investment that rose by 12%. Q3 in 2025 was, in fact, the best quarter on record for grid tech. Distributed energy resources, or DER's, investment has doubled, And both consumers know that DERs are more secure and more flexible than traditional assets. But nuclear is the one that really stands out, as investment tripled as countries race to deploy reactors of the next generation faster and more effectively. Now, more infrastructure funding doesn't mean that novel technologies are shut out of the funding environment. Investors are becoming more ambitious in the risks that we're taking, and we're even seeing new instruments allowing those techs to get onto the next stage, to commercialization. So the good news is that novel tech can access that infrastructure funding if it has all the pieces in place. The example I want to take today is Infinium's project Roadrunner, which is a 23,000 ton a year eSAF plant due to open next year in Texas. It has a trusted supply chain with electric hydrogen for its electrolyzers and NextEra for its power. It has policy mandates creating demand for eSAF in the UK and the EU, as we've seen earlier, following the same trend in ammonia, that supplies is being built abroad to meet those mandates. And crucially, it has firm offtakes from American Airlines, British Airways, Iberia, the airlines that have to comply with those mandates. So what that means is that project was able to get a piece of that infrastructure pie from Brookfield, from Breakthrough Energy, to get project finance from HSBC to build their first plant. This is what a return to basics looks like. So I wanted to end today on this. The pathway to innovation is putting the pieces together and going back to the project development basics, that first-of-a-kind playbook. Stacking the benefits, demonstrating your returns, and meeting the moment. Thank you very much, and safe travels, Zach.